Well, good morning, everyone. My name is Frank Fantozzi, and joining me from our great team is Cynthia Yang and Chelsea Hussey. We are going to talk about the 2025 post-inauguration market and economic perspectives. Needless to say, the first quarter has been interesting, is a kind word I will use, depending on everyone's viewpoint. We have a lot to cover today. There's going to be some ad-libbing given the fact that there's been a lot going on in the past week. But my goal, and I felt like I drew the short straw when we were doing topic changes. I'm going to be handling new administration and policy changes and impact. Chelsea will then talk about the economy and the labor markets, and Cynthia will bring it home and talk about inflation, possible Fed rate cuts, and portfolio implications and positioning that individuals should be considering. I would have to say, while I'm trying to stall, we have to kind of go through a couple slides here and show you the legalese that we have to take place and full disclosure here. So basically, everything here is advice in our opinion. You need to talk to legal, your CPA, or your financial advisor for more detailed, recommendations. So with that, I am going to start, and I'm just making check Cynthia's first slide, the key themes and minds investors up. Because I don't see that. I see you. I just want to make sure. I know we're kind of pausing here, but I don't see the presentation.
Chelsea, how about you?
I can see it. It might be the view you have on your Zoom.
Let's see. Well, let me find out. Gallery. Give me 1 second while otherwise I'm not going to be able to find out where I'm at here. Full screen. Yeah, I'm not seeing the presentation on mine. Well, we'll have to kind of wing it. I'm on the slide. I'm just going to do it verbally because I'm not seeing the slide, Cynthia, on my computer here. So I'm going to go from this version. So I'm on the slide, key themes on the mindset of investors. And so the three themes we're going to talk about today are new administration, policy changes and impact, AI in the job market, and investment opportunities. So with that, I want to start, and I like to use quotes a lot because I think it kind of sets, the tone and the mindset that I feel and we feel as a team we need to, embrace, especially in times of volatile markets. So one is a pretty famous one. Well, they're both famous, but the one that's probably more well known is Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. I think this quote is especially powerful during volatile times, really setting and encouraging longtime investors to see downturns not as threats, but as opportunities when assets may be oversold or undervalued. Another one goes from my days back in college when I used to follow Sir John Templeton of the Templeton Funds. And he always, his big famous quote was, "Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria." And this is really a timeless reminder that market cycles are really driven by investor sentiment as by fundamentals, and that a sharp decline often happens after periods of irrational exuberance and not necessarily signals of long-term doom and gloom. So I think these hopefully will set the mindset for today, and we're going to unpack a lot of material today. So hang on. So the first thing we're going to really start talking about is potential U.S. policy changes in 2025. U.S. policies are set for major reshaping as the full Republican control by a little margin takes hold in 2025. And to navigate these investment opportunities and challenges ahead, we have to explore how these key policy changes may impact economic growth, inflation, corporate earnings, and interest rates. As you recall from the election and the Republican platform, the major initiatives investors had to watch closely were these, four key words that were talked often during the election process: tariffs, immigration, taxes, and deregulations. So they're going to really take center stage. But again, I like to create context. Whoever's really won the presidency on whatever platform they ran on, they all make big, bold promises. As long as I've been alive and following, the presidential elections, I found it very rare that any president during their term was able to accomplish near 100%, let alone maybe 75 or 50%. And part of that is by design. We have three branches of the government, and they have to work in effect together. And there are limitations on the checks and balances. So with that, when any regime gets into play, whether it's Democratic or Republicans, very often their full agenda is never realized. So I say that as a footnote because I don't expect, and as a firm, we don't expect everything to come into play and be fully realized. It's just the way our government's wired, and part of that is by design to really prevent full pendulum swings one way or the other, and try to keep us more in a grounded center pattern. But I do want to create some backdrop because a lot's been going on. I will say, and this is more my opinion, this first quarter out of any presidency has probably seen more sweeping changes at a faster pace with bigger depth than any I've ever experienced in my life. And I think that was partly by design. I think also you have a president that's sitting for one term. So time in this administration is much more limited. And so I think you're seeing all of that manifest into a very frenzied, first quarter. And in that frenzy, something that we're not used to, the pace and the change being proposed, has created a lot of concern and chaos. So the first thing I do want to talk on is before we start getting into tariffs, is to really give some economic backdrop, because tariffs have been around a long time. I think the fact that it's being used much more heavily right now, people are acting like this is a new thing and it's something that only a few countries are doing. So I did a little research. Depending on what how you rank or define countries, by definition, there's really approximately 195 to 201 countries globally. Okay. With that, the Organization for Economic Cooperation and Development comprises only 38 member countries to say that these are considered developed countries. Of all these countries, 170 countries and custom territories impose tariffs and non-tariff measures as part of their economic plan in their marketplace. So what I'd like to really conclude here is that the vast majority of countries, including the United States, and both developed and developing nations, utilize tariffs as part of their trade policies. So I think that's really important. They've been around, they've been used often. Obviously, in this administration, a threat of high tariffs are being thrown around, and we'll talk about those possible implications if they are fully realized. But I want to make sure we level set a little bit to say that tariffs have been around for a long, long time. Countries all over the world use them as a way of either protecting their country, their special industries, or trying to promote them or get their industries off the ground. And tariffs are used just like subsidies, right? Which haven't been talked about, but again, I'm going to lightly touch on subsidies because that's a form of tax as well. And why I say that is our tax dollars are used to support industries, right or wrong, fossil fuels, renewable energy, agriculture, transportation, semiconductor industry. So, on a global perspective, when you look at subsidies as another tool, according to the World Bank, 31 jurisdictions spanning over 50 countries, accounting for 70% of the global market trade, have various subsidy programs in place. And the economic impact, if you quantify from a dollar standpoint, is $700 billion a year. So why are subsidies used? It's kind of a counter action to tariffs, is that they reflect government's strategies to bolster either key industries, promote innovation, maintain economic competitiveness, both on a national and international level. So again, these are things that have been used for years, and it's part of the economic makeup. And lastly, and this is something I hear talked about and use a lot, and I feel I really want to again set some clarity in how words are being used by the media, um, because you hear the terms capitalism and free markets, and what does that mean in theory and versus practice, and how really the concentration of power in certain industries affect pricing, competition, trade dynamics, just like tariffs and subsidies. So again, a little economic lesson, and then we kind of really will dive back into some current graphs and some projections on where we see things happening. So when you look at free markets, because free markets are really a system where prices, production, distribution are determined by supply and demand with very little government to no government interference. Okay, so that's really, really important to understand that. So free markets really rely on efficiency, volunteer exchange, and competitive pricing. And it's very rare in pure form. Most countries blend it with regulatory oversight. So the only way I will tell you to observe free market is if you go to a local market where you have similar people offering for sale similar goods, and people are going around negotiating for their best price, best product, and there is no regulation. What you really have is capitalism. And when they throw capitalism around, it is not free markets. So an economic system where private individuals or businesses own capital goods and production and are motivated by profit. But the key difference here compared to free markets is that there are government involvement. There's taxes, regulations, subsidies, and tariffs. And the focus, just like in free markets, there's private ownership, wealth creation, and capital accumulation. But again, practice on a worldwide basis, including the U.S., they're very much modeled and controlled through regulations, subsidies, tariffs, and protections. So in short, all free market economies are capitalistic, but not all capitalistic economies operate with free markets. So I felt the need to really level set this so that we can have some appreciation for some of the things that we're going to talk about today. But when headlines are looking to create, you know, uh, let's just again, this is my personal opinion. I think the team feels the same way. Headlines sell, and they don't sell on good news. They sell on creating shock and awe, and I think that's what you have a lot. And trying to get true context and balance, you have to work at it. So you have to do some research. You have to figure out how things work, and you have to really look at objective reporting to find out how things are impacting the world, the United States, and at the local level. So with that, I'm going to kind of dive into our first slide, which is going to get into, let's see here, I got to catch up, tariffs and how much higher. So um, tariffs, as President Trump has proposed currently, and right now the current news is he's backing off for 90 days. Just kind of let the dust settle because of all the yo-yo effect that's been going on in the marketplace. But he's proposed a 60% tariff on all imports from China and a 20% tariff on all other U.S. trading partners. So taking literally, these steps would lift the effective tariff rate in the United States by 15 basis points, an historical large increase that significantly exceeds trade restrictions from his first term. So if you recall from his first term, there were a lot of tariffs that were put in place at a much more lower level, and they were definitely carried on by the next presidency, President Biden, and his administration. So during Trump's first term, the administration did not deliver its full extent of tariffs that were discussed on the campaign trail, which suggests to us that significant weight should be placed on the idea that tariff threats are really used for negotiating trade deals and U.S. trading partners who are willing to seek deals to avoid damaging their economies. And people say, well, why do we go to this length? Now, again, I'm not a government official, and I'm not involved in these trade discussions, but I think that the fact is that we have one of the largest economies in the world, and when you look at the consumption and the spend here in the United States, while we can negatively impact ourselves temporarily for a short period of time with increased tariffs, which again, in our opinion, eventually get passed through to us as consumers at some point. The other country will hurt worse, and will likely want to concede. So it's kind of like a game of chicken. And I think that's part of what's been going on, and which is creating a lot of consternation, in the marketplace. In the second term, though, oops, I lost my screen here. Again, I'm having technical difficulties. So second, President Trump has also championed the strength of economy and the stock market during his first term, and an aggressive trade war that risks both, would conflict with his past priorities, such as, moving forward and trying to grow the economy. So the way I would look at tariffs is, an analogy I like to use is, tariffs are like tolls placed on borders. They protect some industries, they may slow traffic, they might even create a traffic jam and create short-term tension, but it clears with policy direction, which I think will be forthcoming, more probably in the third quarter of this year. And as I mentioned earlier, while the U.S. operates as a capitalistic economy, many industries like tech, healthcare, and defense don't operate in a true free market. So market influence, regulation, and consolidation all shape these outcomes. And I would say, think of capitalism as a system, and that the free market is an ideal, and sometimes limited by these real world conditions that we're seeing. So what on the graph you're seeing, and again, I was just providing some background. What we're looking at is peak statutory tariff rates that are being delivered currently, and what is being threatened. And again, this is a moving target. It seems like it's changing weekly. As investors, I think the best thing we can tell you to prepare for is ongoing volatility and sideways movement in the market this year. Now, Chelsea and Cynthia will talk about opportunities that can create. But we do feel that as a company, the markets are going to move more sideways this year, and you're going to have increased volatility because week to week, there hasn't been a set forth clear path yet. And the markets in general do not appreciate lack of clarity. The next slide I'd like to talk about, tariffs that are announced. Now, this is a historical graph, so you can go back, and we've gathered information from 1901, and you could see back over 100 years ago, tariffs were extremely high, and that over time, tariffs, as we become, when we moved from a closed market system, which the U.S. was back in the 1920s, 30s, 40s, as we emerged out of World War II and we became more of a global economy, we've moved to a less tariff-based economic system, and tariffs are then selectively used to protect or promote, certain industries. Also, depending on the counterpoint, what countries that we're dealing with. So right now, where we stand as of April 3rd, and again, this stuff is moving very, very fast, so we're trying to be as current as possible. The U.S. announced a baseline 10% tariff on all goods imports, with the exceptions of higher, what they call reciprocal tariffs on imports from countries where the U.S. has long-standing trade deficits. All countries excluding Canada and Mexico will see a 10% tariff applying between April 3rd on what they call country-specific tariffs that will go into effect on April 9th. So the estimates show that these measures will bring the U.S. effective tariff rate from 2.4% in 2024 to near 30%, the highest over 100 years. So this is something that could be a drag on the economy if it becomes something that's prolonged and institutionalized. We do feel that this is more of a negotiating tool. Now, we've been in only three months, and it seems like it might be already forever that we've been at it. But in the time cycle, how markets work, this is very, very short term. And so we're asking, investors in general to really take more of an opportunistic look at this versus a negative look where the economy dumped into a recession, which I know that has been increased a little bit, the worry of a recession. However, we don't feel, and Cynthia will talk about that in more detail, the fundamentals are there to support it at this point. So exceptions to the tariffs, though, fall into three categories. Goods whose price the administration do not believe will see an increase are energy and critical minerals. Goods already subject to what they call sector-specific tariffs, like steel, aluminum, and autos. And then goods likely to be subject to sector-specific tariffs in the future are copper, pharma, chips, and lumber. So the 34% tariff that was announced, and it has not yet been placed on China because of the pause, is in addition to the previous 20% tariffs. And then regarding our neighbors, Canada and Mexico, the tariffs were left unchanged, 0% on what they call USMCA goods. These are United States, Mexico, Canada agreement on what they call compliant goods. Goods on, excuse me, so there'll be zero tax on those type of goods, 25% on non-compliant are going in place right now and for the foreseeable future. And we're just gonna have to see how Canada and Mexico continue to react and see how these negotiations move forward. Tariffs, again, will add pressure to prices. They will slow growth. And then the Fed policy on lowering interest rates actually will work on the opposite direction. So if tariffs stay within a reasonable range, and the Fed, with its committed policy to lower interest rates, which would help, stimulate the economy, these might actually just neutralize themselves going forward. Next slide I will be going and talking about is the impact of tariffs on inflation. So tariffs can impact inflation through a range of channels, including the direct impact of higher import prices on core consumer goods. Decisions that are not impacted by U.S. Producers to opportunistically raise prices, so that could be influenced there, and higher production costs from tariffs on imported intermediate inputs to U.S. production. So these are the three areas that we're looking at. When these factors, again, can be partially offset by disinflation from weaker aggregate demand and disinflation from the U.S. dollar internationally. So again, there's a counter rate for every action, there's a reaction. So yes, prices might go up, but then if there's less demand for those prices, it could force prices down. And so there's this yin yang, but again, as long as it doesn't get in an excessive range, then we're not as concerned about the long-term implications of lower tariff prices. But what the graph shows you here is the potential impact going forward in 2026 and 2027. If we look at what we call baseline tariffs, which are these dotted lines in green, we're potentially looking at a minimal increase to core inflation. However, if the worst case scenario happens, we could see inflation approach 3.75% in 2026, 2027 on the core PCI. So is it a terrible range? No. However, we would see a negative impact if, for example, the full impact of tariffs go into place. Again, a couple other side notes. Back in the labor shortages of 2021 and 22 due to immigration shifts led to wage increases. This is kind of a little bit of potential history repeating in a different format, just by costs going up by tariffs. And again, tariffs plus subsidies often go hand in hand. Again, many U.S. industries like agriculture, fossil fuels, semiconductors, EV manufacturing. This is just another layer of economic policy that distorts free market, but it's part of this, what they call managed and what I call curated capitalistic society. I'm going to go to the next slide. Tariffs and GDP growth. Let's see, let me get there. Let me get to this. Okay. So President Trump has and is likely to take action to limit immigration flow. And this graph shows in orange birth and deaths, the path of immigration in blue, and then the total impact of population growth. And he's made it a big deal to really focus in on immigration flow by securing our border and limiting the inflow of undocumented immigrants in the United States. So to create context, during 2017 and 2019, immigration added 0.2% to the U.S. population. But immigration since then has been, going into the President Biden's term was 4 to 5 times stronger, and you see that in the blue bars here to the right. As immigration downshifts, the pace of potential economic growth is likely to slow from about 2.5% to 2%. What's not being measured, though, is the impact, and it's really hard to get really good information on the infrastructure that, like healthcare, that undocumented immigration does cause. We look to try to find that counterpoint because there is a cost to, undocumented immigration. So a couple of things. Less labor supply could pose upside risk to inflation, but two important points cut against this. First, U.S. labor market is not overheated right now. So that means if there is a pullback on immigration, there's still the ability to have workers found in the U.S. that don't come here, whether through documentation or non-documentation. Second, if aggregate demand slows on the backdrop of immigration restriction, this would offset the impact of wages on price inflation. So again, there's always a counterpoint to this, and when you deal with a capitalistic society that has layers to it, from regulation to tariffs and subsidies, it's not as easy to point a direct source of why things work exactly the way they work, because it's almost like a quadratic equation when going back to math in high school and trying to figure out how these different inputs will create a certain output. Larger demographic impacts are possible, probably unlikely, but in the second term, President Trump is calling for the U.S. to carry out the largest deportation operation in American history. And again, that was promised. The reality is it's probably unlikely. The question is, where will it truly fall? So, for example, if 1 million individuals were deported, their direct contribution from immigration to population growth would change from a plus 0.2, and you see that in the blue bar chart above, to a negative 0.1. So that's pretty minimal. But if all the estimated 8 million unauthorized workers in the United States were deported, it could push this cumulatively to 6% over a 5 to 10 year process. So it's really key to really watch where I think immigration is fully going to play out. Again, we know there's going to be some impact. Our estimation is going to be minimal. We think the president's going to try to secure the border, take undocumented, what they call threats, and move them out of the country. And then there might be additional immigration move, but we don't believe he's ever going to come close to the 8 million people and have them deported. Most likely, what we see happening is some type of compromise where people that are working here that are undocumented could apply for some type of citizenship. That's our speculation, but it's highly unlikely that through the promise on his campaign that he's going to get all 8 million out of the United States. But the economic takeaways is that workers do contribute to GDP, and depending on the amount of people that are deported, this could have an impact on our labor force, raise labor costs, disrupt supply chain, and slow growth that affects different industries. So it's going to be a wait and see because again, most presidents do not come close to 100% achieving their platform promises. Next slide. And last slide before I pass it on. And one thing I also want to make sure I touch on, and it goes back to the whole immigration side of things, is people sometimes aren't aware that we have an H-2A visa program and an H-2B visa program. And basically, this is a documented process where U.S. employers bring foreign nationals to the U.S. to temporarily work to fill seasonal or temporary agricultural jobs, landscaping, nurseries, greenhouses. The H-2P visa impacts also hospitality, seafood processing, amusement parks, construction. So there is a documented process that companies that are in the U.S. follow to have documented foreign nationals come here to work. So I think that's a program that is probably going to be looked to being expanded and refined so that, again, there's a documented. I think the big key thing here is that they're trying to find a more proven and a better run documentation process to control workers crossing the border versus having it undocumented. So just again, for everyone's benefit, there is, if you weren't aware, that the H-2A visa program, the H-2B visa program are used extensively by U.S. countries to bring in, foreign workers here to work here on a temporary basis. Okay, I thought I wanted to share that as a backdrop. And then let's see, fiscal policy and tax cuts. So at the end of this year, end of 2025, the tax laws that President Trump put in his first term are set to expire. So there's a lot of discussion on what's going to happen with the Tax Cuts and Jobs Act from President Trump's first term. Most likely, all of it will probably stay in place except for the 10%, excuse me, the $10,000 cap on state and local. There's a lot of backlash, especially from homeowners who are working between their state and local income taxes and their property taxes, especially those that live on the coast or what we call high rent districts. They were extremely impacted by the limitations. So I think that's going away. We're looking at that as a positive because there's a multiplier effect that the Congressional Budget Office looks at to see how that will impact the economy. And so basically on the lower middle class, they look at a 0.3 to 1.5 multiplier on the value of those tax cuts. And the impact from higher income individuals is actually lower. It's 0.1 to 0.6. So the positive of the fiscal policy and the tax cuts, if they are extended, which we expect to do that to happen, except for the SALT deduction, will be a positive to the economy. Another discussion point here is President Trump and the Republican Party are looking to cut the top rate on corporate profits from 21 to 15%. If that were achieved, which is unlikely, it'll probably fall somewhere between 21 and 15%. It'll make U.S. one of the lowest corporate tax jurisdiction of any large wealthy country. But again, however, part of the reason why we feel that this proposal will be difficult to achieve is we're extending the TCJA cuts, right? And again, you have to figure out how to balance your budget. So we're cutting revenue, and we're not figuring out offsets to government spending. And so the question in balancing by extending the Trump 2017 tax laws and trying to lower corporate taxes is that will the income from all those tax cuts basically, spurring the economy on, offset the revenue that's lost from not being taken in? So it's unlikely that the corporate rate will drop to 15%. It'll end up somewhere being 21 to 15. I'll be glad to start taking wagers on it, but I don't know where it's going to fall myself. I just know it's highly unlikely to get down to 15%. And again, the whole idea here is to bring back, if you think about the promises and the ideas here, is when the U.S. had a higher tax rate, companies were moving their headquarters and manufacturing other things overseas because they were losing too much in tax dollars. So we were actually losing companies' revenue to other countries because we were not tax friendly enough. So I think the whole goal here is to continue to make United States a competitive place to house your company's operations. Lastly, repealing tax cuts and credits. We also have to, at the end of the day, look at some of these Inflation Reduction Act that provided incentives in production and use of green energy. I think President Trump and the administration is looking to peel that back, partly because they don't believe in enforcing and incentivizing green technology ahead of other technology should be subsidized, by the government. And so I think some of those tax credits will be going away and could impact, investments in green technology short term, not long term. And I think my last slide is deregulation. So a lot of business owners tell you at a local, state, and federal level, red tape is made it very difficult to get things done. And I think what you'll see here is, you know, when you go back to what happened in 2008 and 2009, when we had the Great Recession, a lot of regulation came back in place, especially in the financial markets. And you can see by the graph here, it's a percentage of small businesses citing red tape as the single biggest problem, peaked in 2015, 16. And now it's been on this trajectory to get reduced. And the reason why I think this is going to be successful is that President Trump has the power to appoint heads of federal agency. He also has the power to influence the regulatory landscape for business. And the regulation and policy reforms are likely particularly going to be in place for financial and energy sectors. The president also has the power to appoint heads of executive agencies, which is granted to him in Article 2 of the Constitution. This grants the president considerable control over the regulatory agenda and how strictly agencies enforce current law. And so these two sectors have received the most attention for deregulation in Trump's second term. So I think what you're going to see in the energy is reverse restrictions on greenhouse gas emissions. And again, we're as a company, we're not saying this is good or bad in regards to supporting these decisions. Our goal is to let you know what potentially is going to get impacted and how this could impact the economic landscape from an investment standpoint. So you're going to reverse restrictions on greenhouse gas emissions. There's going to be more support for energy production, including oil and gas development. Again, reinforcing our energy, trying to be energy independent. Expand U.S. liquid natural gas exports, and EPA rulemaking to decline what implications other sectors are being impacted. For example, relaxed vehicle emission targets. And then he plans on pulling the United States out of the Paris Climate Accord once again, which I believe he has done. And so these are all the things that are happening on the energy front. And I think a part of it is on the Paris Climate Control. I think, and a lot of the actions, again, right or wrong, if you listen to what the current administration is saying, is the United States, on a pro rata basis, is taking on a bigger burden than more other countries, and he feels, and in his administration, he's trying to level the playing field. And again, that goes back to tariffs and trying to use tariffs as a way of forcing negotiation. Again, we're not saying that's the right tactic. That's just a tactic of choice of the current administration. The financial industry, they're going to roll back Consumer Financial Protection Bureau, pause the Basel III endgame proposal, which would have raised capital requirements for regional banks, allow more mergers and acquisitions, which could benefit sectors like mid cap and small caps. But there's a whole private industry that doesn't impact the public industry. That right now it's kind of interesting. I was at a conference, a deal makers conference, and one of the concerns that are being raised, if you're going to buy and sell companies, and if those companies' revenues and expenses are impacted by tariffs, everyone's kind of putting a cautionary look at mergers and acquisitions. So one of the potential negatives of uncertainty, especially with tariffs, not only in the public sector where you got mid cap and large cap stocks, buying and selling, it's in the private sector, which is there's a lot more mergers and acquisitions going on. That could be at risk intermediate term if these tariffs become very excessive, and the length of time these tariffs stay in place are prolonged. Lastly, a few other observations I'd like to point out. The heads of independent federal agencies like Chair Powell at the Federal Reserve, he can only be fired for cause. Because there's been a lot of talk about trying to create independence between the administration and the Federal Reserve. There's always been a question mark about, okay, how independent is everybody? Just for everyone's benefit, Chairman Powell's term expires in May of 2026. If he were to resign before 2026 or be replaced, investors are likely to focus on a couple things. One, the independence of the U.S. central bank and its commitment to hit the 2% inflation target. Perceived threats to federal independence could unanchor inflation expectations and push long-term interest rates higher. So challenges to the federal independence are not unprecedented. So through the terms of President Harry Truman in the 50s, Lyndon Johnson in the 60s, Richard Nixon in the 70s, covertly, and it's well documented, they put a lot of pressure on the central bank. So following Securities Exchange Chair Gensler's announcement to resign, the expected new SEC leadership will likely halt the agency's pending climate disclosure rules in 2025. So again, this all plays into the regulation and to make it easier to conduct business. The theory is if it's easier to conduct business, more people will get hired, revenues go up, there's more money to be made. And I think that's the whole idea, is just to make it easier to get business done. Again, the business of small business citing government red tape is the single most important problem, declined markedly during Trump's first term. And again, I think his administration is looking at making that another goal in his second term. I think with that, I think that's my last duty here today. And I'm going to toss it over to Chelsea. We're going to do questions at the end. If there are questions, and I see some in the Q&A, we'll make sure we address them. But I'm going to allow Chelsea to start on the artificial intelligence and the labor market.
Thanks, Frank. So you're probably wondering why we're really talking about AI and the labor market. And for those of you, whether your clients or not, who might be burned out on the news cycle and pundits and talking heads and articles, the reason for why we do this webinar and why we cover the topics that we do is we care about these topics to the extent that they're impacting you, our clients, or the people who are working with us. And so why we're bringing up AI and its impacts to the labor market is, on the one hand, for our clients who are still working, there's certainly a question of how will AI impact me and ultimately my financial plan. For our clients who are retired, there's a question of, is there an investment opportunity there? How might this change things or impact me over time? And then overall, for all of our clients and the people that we work with, is how does the advancement of technology contribute overall to all of this other turmoil that's going on? Does it help it? Does it hinder it? Just like Frank was talking about with the different variables as it relates to immigration, there are areas where offsets of GDP in one area might be triggered or go in the reverse by rapid improvements in productivity and technology. And so to give you a little bit of context of why we bring this up and why we're getting into this for you. So first, taking a look at the impact of AI on jobs. So the question for a lot of people is, will AI really replace human jobs? Yes, at least according to the data, and this appears almost unstoppable. And to give a quick asterisk to this, when we're talking about AI, it's not just what artificial intelligence really means, but AI functions because the computers or the processors that are needed for these algorithms to create this artificial intelligence, this not only creates that, ChatGPT or anything else that you might interact with, but that faster computing power for those algorithms has implications in every area of the economy, from manufacturing, building, designing. So that's this is not just a human to ChatGPT sort of interaction, but really, how does the technology that creates this impact everything? So now we have the Tony Blair Institute. This is a research organization in the UK. They pointed out that even without considering future advancements in AI, its current capabilities are enough to reduce total societal labor time by about 23%. In other words, 23% of jobs could potentially be cut immediately. There's also a recent report by the IMF that highlights that in developed countries like the US, 60% of current job duties could be affected by AI or outsourced to AI. And among these, half, which would be 30% of workers, could be directly replaced. I'll note, though, that the IMF, the International Monetary Fund, this report came out of their meeting of the World Economic Forum in Davos in January. The report is a little bit doom and gloom. I'll say that much. And the theme actually for their World Economic Forum this year was rebuilding trust, because they've been seen as a little bit out of touch and a little bit alarmist and even a little bit elitist. So take a little of those reports that you see with a grain of salt. But clearly, the impact of AI on human employment is not just a future possibility, it's already happening. So the question is unemployment inevitable? So let's go back to history for a little bit of context and some answers. So going back 100 years, another huge technology breakthrough that, just like AI today, dramatically increased productivity was the assembly line system invented by and really popularized by the Ford Motor Company. Ford was inspired by a visit to a slaughterhouse, and the engineers applied the assembly line method to auto manufacturing, which significantly improved production efficiency. It increased the number of cars that could be produced a year from 8 to 25, more than tripling productivity. While higher productivity is generally a good thing, it also caused widespread anxiety among workers at the time, because Ford could now accomplish the same level of production with technically 1/3 of the original workforce, which meant some workers were bound to lose their jobs. And this pretty much mirrors the concerns that we see today about AI. Paradoxically, however, mass layoffs did not occur, and instead Ford ended up hiring more workers and even increasing their wages. Why? The answer lies with the drop in car prices. Since cars became much easier to produce, their costs plummeted. It cost $850 to purchase a car in 1908. By 1924, $260. So as prices fell, more ordinary people could afford to buy cars, and as a result, cars quickly became a staple of the middle-class economy, and demand skyrocketed 20-fold in just a decade. So to keep up with this explosive demand, Ford not only had to retain his existing workers, but had to hire more workers at higher wages to maintain production. He had to pay those more competitive wages to ensure that he wasn't experiencing turnover, because that would lead to a loss of inefficiency. And with this popularized efficient method of building cars, that also increased competition. So when you have to keep your people, you got to pay them a little bit better. So he also is famously noted as saying that he wanted his employees to be able to buy cars too. And so he wanted to pay them a competitive living wage. What's interesting is around the same time, Ford also pioneered the 40-hour work week. He limited it began with factory workers and then went on to office workers, but he started this in 1926. This was not a federal law until 1940. So in 1926, Ford said, I'm limiting production to 40 hours a day, 5 days a week, which makes you wonder, maybe with the next technological revolution, if we can't drop down to a 4-day work week. I think that'd be pretty nice. So wink, wink, Frank. This example, though, it illustrates a crucial principle in that productivity improvements don't just allow fewer workers to do more on the supply side, but it also drives greater demand on the consumption side. In Ford's case, the demand side effect was far more significant than the supply side job reductions. However, people tend to overlook this and focus only on the threat of job losses from productivity gains. The productivity revolution brought about by AI today follows a similar pattern. Moving into AI in healthcare as an example, some argue that AI will handle a larger load of online medical consultations while also optimizing many aspects of doctors' workflows, potentially leading to mass unemployment among physicians. This perspective, however, just like with the slide before, only considers the supply side. If we also factor in the demand side, the outcome might be a little bit different. Thinking about this, does our current healthcare system fully meet society's demand for medical consultations? Absolutely not. Even in developed countries, medical care is prohibitively expensive without insurance, and even with insurance, you have long wait times of 4 to 5 hours, long scheduling out for even some of the most basic consultations or to see a primary care doctor. And that deters a lot of people from getting the medical attention that they deserve. Now, if we imagine a world where AI has greatly enhanced doctors' efficiency, reducing the cost of medical consultations could improve both their quality and their availability. In such a scenario, people would be much more willing to seek various medical services. So even if AI takes over part of the workload, the surge in demand would likely create an overall increase in the need for doctors. Not only would we need more specialized treatment, but we would still want those certain human elements of care that just can't be replicated by AI. And the same logic applies to other areas like legal services. Most people don't casually consult a lawyer when they encounter legal issues because legal services are so expensive. If AI were to drive down the cost of legal services, there could be, again, a corresponding increase in demand that would lead to a rise in the number of attorneys rather than a decline. So in short, while AI is transforming industries and reshaping job markets, history suggests that its long-term impact may be far more complex than simple job elimination. Let's go to our most recent revolution. So throughout history, society has undergone numerous productivity revolutions, both large and small. But without exception, the ultimate outcome has been that the increase in demand far outweighs changes on the supply side, which as a result, rather than leading to waves of unemployment, these revolutions have consistently created more jobs. Taking, for instance, the most recent and perhaps most significant productivity revolution, the internet. According to a McKinsey report, since 1980, the rise of PCs in the internet economy destroyed approximately 3.5 million jobs. Many professions like typists, telegraph operators completely disappeared. On the other hand, PCs and the internet have also generated more new opportunities. Data shows that these technologies have created over 19 million new jobs. In other words, rather than reducing unemployment, the explosion in productivity brought about the internet actually resulted in a net increase of 15.5 million jobs. And this pattern has occurred countless times throughout US history. While researching this, we made every effort to find where there was a net loss in employment. And after extensively searching, we couldn't find any examples. One interesting one, an interesting note that I saw of an industry that was created were ski resorts after World War II. People, I'm sure, have been skiing in some way, shape, or form for centuries, but after World War II, with the rise in productivity, the rise of the middle class, the accessibility of cars, all of a sudden, a new industry of a ski resort came to be. And you had this new industry with jobs of lodging and ski instructors and all of this whole new ability to, producing and manufacturing and making efficient ski equipment, because people could now drive to these places that they previously couldn't access. And so I found it interesting that while the commoditization of the car may have seen the death of the carriage industry, whole new, completely unrelated and hard to imagine industries popped up as a result. So over hundreds of years of economic history, every major technological revolution has, without exception, created more jobs in some respect or another. Now, there could be a short-term impact where job creation lags behind job displacement, leading to a temporary surge in unemployment. So looking at the impact of AI on unemployment, this is a valid concern. After all, the employment metric is one of the Federal Reserve's most closely watched indicators. If unemployment rises, it could influence interest rate policies, which affects everybody's financial well-being, whether you're working or retired. Based on historical data, however, the likelihood of widespread panic is relatively low. While productivity surges, will be some localized job losses in the short term, but the overall impact on unemployment is pretty minimal. Statistics show that since 1960, the U.S. has seen productivity increases coincide with employment and declines in only 12% of those cases. If we extend the time frame to 3 years, the pattern becomes even clearer. In 95% of cases, productivity gains have been followed by employment growth. Now, going back to that though, what about the 5% of extreme cases where job losses did occur? In a study by that Tony Blair Institute that I mentioned before, found that even in the worst case scenario where labor markets experience severe skill gaps and adjustment delays, the impact would only be a 0.5, a half a percent increase in unemployment, 0.5%, and that's over a 15-year period. For the next for the next 5 years, the maximum estimated change in unemployment would be no more than about 0.1%. Now, this study was based in the UK, but its authors suggest that this could apply to other developed economies. So in short, the short-term risk of unemployment, of an unemployment crisis due to AI-driven labor shifts is, for the most part, relatively low. Even in the worst case scenario where AI adoption is exceptionally rapid, causing temporary job displacement, this might not necessarily be bad for investors. If mass layoffs are truly driven by AI, it means that businesses are experiencing significant cost savings and efficiency gains, which is a strong indicator of rising corporate profitability. At the same time, if the Federal Reserve notices a concerning increase in the unemployment number, it may respond by cutting rates, which stimulates job creation, makes the cost of borrowing a lot easier, and gives the market another potential boost. So overall, while rising unemployment due to even an economic recession, that's undeniably negative for the stock market, if unemployment stems from productivity gains, the implications can actually be positive. As investors, we encourage our clients to really focus in on the underlying cause, not just the headline unemployment numbers. Now, Cynthia is going to talk a little bit more about the portfolio implications and a lot of what we're seeing right now.
Well, thank you, Chelsea and Frank. So what can we do in those type of market when in the last couple, 3 months, with all the turbulence that we have experienced, those escalating trade war really roiled the market. To give you a little bit context, we look at the WIX, which is the Chicago Board of Exchange Volatility Index. Average-wise, it is around 19 to 20. Last Friday, that escalated to 45, which is highest post since 2020. WIX is an index which used to gauge the investors' sentiment. Any number above 35 shows a strong signal of panic. So with last Friday's rating of 45, it is well above the normal, and that's signaling fears and uncertainty in the stock market. On the same day, NASDAQ lagged about 5.8% and officially entered into the bear market territory after falling more than 20% from its peak. And however, yesterday, as we all know, after the announcement of the 90-day pause on the new tariff, NASDAQ rebounded sharply, recovering nearly half of its loss in just one single day. So in such a turbulent market, it is so unpredictable. What could we do to protect and grow our wealth? I'm sure that a couple of the discussion points I'm going to cover later is not new to you, but it's worth emphasizing and mention that the strategic like diversification across broader asset class, focus on high quality and defensive stocks, and taking a long-term investment perspective, those are all the strategies that could help us weather through volatility and difficult markets. Additionally, incorporating fixed incomes and consider adding risk hedge tools would also help provide stability and opportunity during uncertainty market times. Now let's take a quick overview of the market. These screenshots were the stock market update as of Wednesday. I'm sure that if we update it according to Thursday, the number will be looking very different. We will have more greens than pretty much all red on the screen. The key takeaway from this chart is after leading the market growth for over 2 years, we finally started to see a shift from high growth technology stock to value sector this year. The winners, if I can draw your attention, I know there are tons of numbers on this page. If I can draw your attention on the bottom towards the right, we can see the year-to-date sector return. And that really tells us what are the winners and the losers as of this year. The obvious winners for the sectors are the defensive sectors like utility, healthcare, which has gained some tractions. The rising interest rate helped boost the financial sectors, but hurt real estate and consumer discretions. Infrastructure spendings help boost the demand in industrials. Healthcare and utility are considered as the defensive asset class and usually attract risk-averse investors when the volatility picks up. So those are a couple of the winners as of this year. But the losers obviously are the technology growth stock. The high inflation pressure and the high interest rate has been significantly reduced the future earning potential for those sectors, and therefore there is a drawdown in this sector. And another sector got hammered the most is the consumer discretionary. Again, inflation pressure lower the spending power, and consumer at this point are very hesitant to spend on big ticket items, trying to wait and see. So the consumer directionary sector also get hit the most as of year to date. Now, this sector rotation actually present opportunity for active investors if we monitor where the market are really heading to instead of rear mirror looking at what are the best performers in the last 2-3 years. It gives us the opportunity to really buying those underperforming but reasonably valued stock positions, reposition your portfolio given the expectation of where those market are gonna head to. And diversification really help to mitigate the sector's specific risk. I'm sure that we all have friends or family members that has been bragging about how great one single stock position, especially in the AI or tech sector, has been helped them generated better than performance return in the last 2-3 years. But imagine if that is the only position that this investor has been holding, how is that portfolio look like in a year like this? So diversification is always the key. And beyond that, trying to figure out where the market really gonna head to instead of based on the historical returns, figure out where the sectors industry are undervalued and being proactive about it give us a really good opportunity to not only weather through the volatility like this, but position you for the long-term success in the future. Another thing we would like to really stress is a key fundamental principle of investing. It's very simple, is buy low and sell high. But however, even though it's a very simple principle, most investors kind of struggle to implement it very effectively. A lot of investors tend to act the opposite way when market are really high. And everybody were talking about the great performance they had in their portfolio. Those that who were hesitant to get into the market feel like, okay, now is a good time to get into the market, which usually is not. And on the opposite side, when the market are bleeding, we have seen that in the last couple of weeks, couple months, that everybody were concerned where the market gonna head to. And that was actually a better opportunity for us to buy the dip and be opportunistic about it. But most investors tend to feel like, okay, there's too much going on. I cannot handle this much of volatility. I want to be out of the market at the wrong time. Couple common investor mistakes we would like to highlight here. One is to really holding too long and being emotionally attached to a stock position. That it really applies to diversification. You could have a great winner like Nvidia, right? In the last 3-4 years, that is the best performing stock in everyone's portfolio. And if you have 10 to 15%, that reason arguably is a good allocation. But if you bet on that one single stock, have over 50% exposure in a position like that, it will create a whole lot of short-term volatility in your portfolio. So diversification is always the key. We can't emphasize enough that do not attach a emotion or fall in love with a single stock position or a single sector. Number two is panic setting during a market correction. Some market corrections are rather short term but most some investors tend to, anytime there's a market correction, some investors tend to interpret it as more of structural market downturn and sell at the wrong time. That is a number two risk that investors tend to make. To put it into context, in the last, I would say in the last 10 years, 2018 was the first term that Trump introduced the trade war. And at that time, it was just between US and China. 2018, NASDAQ from the peak to the bottom dropped about 24%. And yet that year, market closed with a much more moderate drop of close to 4%. And that drawdown took about 5 months to completely recover and recoup that loss. That was 2018. Now we fast forward to 2020. If you recall, in February to March 2020, there was about 3 weeks, we have a drawdown of up to 33%. Less in a month, market dropped beyond 30%. And it took about 6 months. By probably the end of September, we fully recovered that loss and market rally from there until 2022, which was introduced by the Fed interest and monetary policy, that we had another bear market year that S&P, NASDAQ, S&P dropped over 20%, NASDAQ gave back above 30%. Even the bond market gave back about 14% in 2022. And that took about a little bit over a year for the market to recover. And then we had another bull market in 2024. So the key point here is at this point, we don't feel that fundamentally there is any major issues or crack in the economy that could lead to a long-term recession. So when there is a market drawdown of beyond 20%, it is a great opportunity to buy the dip instead of sell and get out of the market. So following this page, I would like to introduce 2 investment opportunities for those who are still very concerned, like, Frank, Chelsea, Cynthia. I could logically agree on what you're trying to deliver, but emotionally, it's still very difficult for me to see all the up and down in the market from day to day. That's just too much for me. What can I do? Those 2 investment options could potentially help you to better protect the downside, so you don't need to be too concerned if we add a better buffer to the downside protection of your portfolio. At the same time, continue to allow you to participate on the market upside. So the first investment opportunity I'd like to introduce here today is a 5-year due directional callable note. Now on this page, it shows the call premium. What those notes are being designed or structured is a 5-year term. So you have to make a commitment to it, similar as the CD, but this is not FDIC insured CD, is a note with a term. So if you are willing to commit it to a 5-year term, and the callable premium on those notes give you a guaranteed, which is a contractual premium, that if those notes ever being called, on this page, it shows you how much a call premium you will be get paid if the note is ever being called on that month. So the first year is non-callable. Starting from month 13, on this page is an illustration to show you a note that being invested in March 2025. So April 2026 is month 13. If the bank decided to call this 5-year note back, you as the investor will get 20% as the call premium. That is a contractual agreement. If we look at the April 2027, if it's being called 2 years from today, that note will be paid 40% call premium. And in between, every month, there is an incremental increase from month to month in between. So the point here is, given where we are at the market today, if you are very concerned for the short-term market volatility, those could give you a really good return if the note is ever being called in the next after a year from now. And if the note is never being called and is mature at year 5, we have 3 potential payouts. To put those into context, consider you have a balanced portfolio where you have 60% in the stock market, 40% in the bond market. And now we are trying to reposition the stock exposure where you are concerned about more about the downturn, carve out 10% or 15% of that stock market and adding that to the structure note. So investment strategy A is stay in the market right through the course for the next 5 years. And investment strategy B is carve out a portion from your stock market, adding that to the structure notes. So now we're going to look at the 3 potential payout at the end of year 5 to compare strategy 1 and B. Payout number 1, if market at end of year 5 end up on the positive territory, you will have a investment strategy A is you, for your stock position, you participate 100% on upside. Very simple. Investment strategy B, for the portion you carve out and invest in the structure note, you are having, for this illustration purpose, you are participating 180% of the upside potential. See that for the 5-year time frame, if stock market give us 100% return for the 5 years, your payout for the structure note will be 180. Now, if the stock market only give us 10% in the next 5 years, you will receive 18% from the structure note. So payout number 1, comparing to staying through the course, it allow you to outperform the market if the market end up in the positive territory. Payout number 2, if this structure note come with a 40% barrier, what that means is you are not going to participate in any market loss up to 40%. And to provide you a better return, the note is a due directional. So any market drawdown below 40% at the end of year 5, you receive the positive return of that market drawdown. Say that at the end of year 5, this note matures, S&P 500 dropped 13%. You receive a positive 13%. If S&P 500 in end of year 5 dropped 39%, you receive a positive 39%. So again, payout number 2, when we look at investment strategy 1, stay in the course, you participate dollar for dollar loss if there's a market drawdown. Payout investment strategy number 2 for the structured note, that any market drawdown below 40%, you receive the positive return of that market drawdown. So payout number 2, again, we're going to outperform in a market drawdown and comparing to stay in the course. Payout number 3 is, what if we have a market drawdown beyond 40%? In that scenario, the two strategy will perform pretty much the same, because for the structured note, beyond 40% barrier, you have a dollar for dollar participation. And staying in the course, still, you have a dollar for dollar participation in the stock market. So payout number 3, you will have equal or same result. Now, let's look at the likelihood of, in the 5-year time frame, what are the probability that the market is going to end up in the positive territory, in the negative but less than 40% drawdown, and what are the likelihood that we're going to have a 5-year time frame and the market drawdown is beyond 40%. On the following chart, the only number I would like to draw your attention is on the right, S&P 500 index. If you look at 5-year probability, and on the left, if you can find the 40% barrier level. So that gives us, over the last 60 years of any 5-year trading horizon, what is the probability that S&P 500 in 5 years would have a drawdown more than 40%? And the probability is 0.04%. So when you look at the 3 different payout between the 2 strategies, payout number 1 and number 2, if market have a positive return, or if market has a drawdown but less than 40%, in both scenarios, it's going to allow you to outperform the market. The only scenario that you're going to have the same payout or the same investment outcome is market have over 40% drawdown, but that probability is less than 1%. So for anyone who are still very concerned about the short term, this could be a really good strategy for you to stay in the course and allow you to potentially outperform the market, outperform your current strategy with a great downside protection up to 40%. And the last strategy I would like to introduce to you is for those who are still very concerned, like, if this is going to be another 2008, 2009, if this is going to be another tech bubble that it's going to take years for the market to recover. Well, we don't believe so. But if that is a concern on your mind and you are looking for some sort of a secure downside protection to cover any potential loss, this could be a great investment strategy for you, is a principal protected note. As the name indicate, it helps you to remove all the uncertainty on the downside. It doesn't matter market has a drawdown of 5%, 10%, 50%, 60%, you're not going to participate in that drawdown your principal is 100% protected. On the upside, though, because this strategy help you take away all the uncertainties on the downside, it does come with a price, and the price is the upside cap. Now, for this illustration purpose, the upside cap is 50% for the next 5 years. That means if S&P deliver a return in the 5-year time frame anywhere between 0 up to 50, you still have 100% participation in the market until the 50%. If market deliver a return in 5 years, a 51% return, you get 50. If market deliver 120% return in the next 5 years, you still get 50 because of the cap there. So this might be something for those two are the strategy that we feel that it will help you to ease some of the concern about the short-term uncertainty if you are still very concerned and not sure what would be the best way to help you protect the downside. This is conclude the presentation for today. And the key takeaway for today's presentation, we discussed about the tariff, we discussed about the policy uncertainty, which we still believe at this point it's going to be short-lived as we see what happened yesterday. Tariff is likely being used as a negotiation tool than being a reality and sticky here for the long term. Artificial intelligence, we discussed about the immigration policy, and artificial intelligence could potentially be the solve that can help to improve the productivity and create new job opportunities at the same time. And the short-term labor market impact by immigration could be helped by potentially by artificial intelligence. On the short-term market volatility, again, we can't emphasize enough that selling by emotion is never a good strategy, and we can't emphasize enough that timing the market is a double-edged sword. That if you want to time the market, you have to time the market right when you get out, and again, time the market right when you want to get in. Short-term volatility usually create a better buying opportunity, and stay in the course and being diversified, trying to focus on those quality investment will be the key to your long-term investment success. And again, for those still very concerned about the market, we introduce 2 structured note that could potentially help you hedge the short-term market downturn and allow you to stay in the market and eventually help you to potentially outperform your current strategy and potentially perform the market.
Oh, so, yeah, I was going to say, you got the next slide?
Yeah.
Yeah. First of all, I want to thank everyone for attending. I see we have 2 questions, so I'm going to pop those open. Let me see here. Do we have the number of immigrant workers Ford brought in to support his growth? Detroit has the second highest Middle Eastern population outside of the Middle East. Signage in Arabic in the area due to the recruitment and numbers of Middle Easterns Ford brought into this work. Unfortunately, I don't, off the top of my head, and I think our team, we don't have, that's pretty specific. We'd have to do some research. So if you want to email us, or you can email me at frank@returnonlifewealth.com, we could take a look and find out that specific, question.
Yeah, there isn't a ton of data on it. From what I saw, I know that Ford established the Ford English School, where a lot of the immigrants that worked at his factories from multiple backgrounds were educated in in English. He also had the Ford sociological department, which it's unclear exactly what the methods were, the goal was behind that. It almost, in reading it at a high level, sounded like his own sort of DEI department, but not really as such. So I guess to the point of the question is I think some additional context would help us understand, for the person who asked what specifically you're looking for, if the impact of immigration on Ford's auto workers would diminish the productivity from the technology standpoint, or if it's something to take into account. I think it's certainly an important piece of context. The key reason that we bring up the Ford Motor Company is really what that particular type of innovation that he was able to capitalize on, how that it contributed to increased demand, and then making a company more efficient.
And another question your way, Chelsea. Do you have any information or projections as to the impact some of the Ohio legislation recently passed impacting education that will impact our workforce in the state in order to be employable in an AI age, or other levels of education and levels of education that is needed?
I haven't seen any particular projections. I know that there was an initiative last year, Innovate Ohio, which has a strong AI focus. They actually have like a couple events coming up soon where they have this toolkit that they've launched for not only people in the industry, but also matching up with instructors or educators to try to incorporate anything that's it's such a broad umbrella, but anything that's kind of AI related into that into the fold, to make sure that it's not being ignored or left behind in the school system. But as far as how that dovetails with the recent legislation passed, it's hard to see. But I certainly agree with the point that as AI or any sort of high processing computing can make some job sectors and job duties more easily performed no longer by humans, but by some form of intelligence, it's that there is going to be an increased demand for not only higher skills, but greater degrees of specialty. And I would even argue some of the soft skills that may or may not be taught directly in education, but things that are hard to be replicated or difficult to replicate in an AI field. So thank you. I see that so the connecting on the workforce productivity and impact on the market is good.
Yeah.
Yep.
Any other last minute questions? And I'll give us a little send off. But we, on behalf of Return on Life Wealth Partners, Cynthia, Chelsea, and myself, it's always an honor to provide information to our clients and friends in this format. We definitely empathize that there's a lot of commotion going on in the markets, understandably so. It's not a surprise, or an ambush, kind of like what COVID was back in 2020. We heard of it, but then COVID was this big unknown, and we emerged through COVID very successfully. We do feel the same here. The underlying fundamentals of companies before the year started were very strong. I think it's the goal of the administration to put United States on better footing with its trading partners. I think that's the goal of all this. If I had to sum it all up, I can't say I may agree with all the tactics, but at the end of the day, we have to allow the administration to play through this. But it does, provide opportunities from an investment standpoint. But I think the key thing to keep in mind in uncertain times is naturally to feel uneasy. We totally get that. It's like going into a dark tunnel, and you don't know where you're going to go. But it's also what we feel is thoughtful planning that matters most. History has definitely shown us that markets reward discipline. Think about .com, the .com bust, Great Recession, the 2020 pandemic. These are the most recent in the last 25 years. And clearly, investors who maintain conviction to their strategy are rewarded over the time. So we always reflect, and when we work with our clients, is to focus on strategy. Does the strategy align with the financial plan? Do the investments support the strategy? If those are all being checked, then you need to execute, and that's really the difference between investors being successful and investors who fail to execute and become overly emotional and try to outthink using their emotions versus using the data that's in front of them. We're committed to helping everyone. We're here to guide and not just through the market noise that we're experiencing now, but really focusing on goals, peace of mind, and on a life well lived. So if you do have any questions that come up later on today, this week, feel free to shoot us an email. Feel free to give us a call. We're here to help. And if you know anyone else who would like a second opinion on their situation, we'd be more than glad to assist. But again, it's always an honor to try to provide help and insight based on the knowledge and information that we have. We do feel that this uncertainty that we're going through this part of the year, and I think it's going to continue probably another 3 to 6 months before things settle in. We'll be coming out of it on a better note. So with that, have a wonderful spring, and hopefully the warmth and sunshine will start following us. Okay, take care, everyone. God bless.